Nobody told you that your mortgage might be working against you, and your bank definitely isn't going to bring it up. What if the account sitting quietly behind your home's equity could actually behave more like a checking account, a savings account, and a loan payoff machine all at once? Welcome to what the financial world can't seem to agree on what to call the all-in-one account, the offset mortgage, the sweep account, the first-lien HELOC, pick your flavor. They're all cousins at the same family reunion. The naming chaos isn't accidental. Different institutions brand the same core concept differently, which means millions of homeowners walk right past this strategy without ever recognizing it. At the heart of it, what we're really talking about is a home equity line of credit, a HELOC, but not the kind parked behind your mortgage like a shy sidekick. This one steps into the first position, replacing your traditional mortgage entirely and becoming the primary loan against your home. Here's where the math gets genuinely interesting. And stay with us, because this is the whole game. Traditional mortgages calculate interest on your outstanding balance at the end of a billing cycle. But this structure calculates interest based on the average daily balance throughout the month. Think of it like this: your regular mortgage is a bucket with a slow drain, and interest gets charged on how full the bucket is at midnight on the last day. The all-in-one account is more like a live river, where every drop that flows in immediately lowers the waterline, and interest is only charged on what's left standing. So when your paycheck hits this account, whether it's weekly, bi-weekly, or a quarterly distribution from your LLC, it immediately goes to work, reducing the average daily balance. You're not waiting until payment day for that money to matter. It starts cutting interest the second it lands. Now, here's the part people get tripped up on. And it's a fair concern. HELOCs traditionally carry variable, often higher interest rates than a fixed conventional mortgage. On the surface, that sounds like you're trading a safe, predictable payment for something riskier. And that instinct isn't entirely wrong. But the counterintuitive truth is that a higher rate on a meaningfully lower average daily balance can result in less total interest paid than a lower rate on a balance that barely moves month to month. It's not about the rate in isolation, it's about what that rate is actually being applied to each and every day. The historical data that backs this up isn't new Australian banks popularized offset mortgage structures decades ago, and studies showed borrowers were eliminating what should have been 30-year mortgages in as few as 8 to 12 years. The mechanic isn't magic, it's just arithmetic that finally works in your favor instead of the bank's. The misconception we need to address head on is that this strategy requires you to earn more money or live like a monk. You don't need a higher income, you need your existing income flowing through the right container, which is a very different conversation. What this strategy rewards is behavioral consistency, not financial heroics. Depositing your income directly, keeping expenses managed, and resisting the urge to treat the available credit like a spending invitation, those three habits alone can dramatically accelerate your equity growth. There's a real discipline component here, and that's worth being honest about. Because the same flexibility that makes this account powerful can become a trap for someone without a plan. The line of credit doesn't care whether you're using it wisely or recklessly. That part is entirely on you. From a risk management perspective, you want to approach this with appropriate position sizing, meaning don't restructure your entire financial life around one tool without understanding your cash flow patterns, your income stability, and your personal spending behavior first. The strategy compounds patience. It punishes impatience. At its philosophical core, this is a story about turning the flow of money into a weapon against the cost of debt, which is almost poetic when you consider that banks have been profiting off the opposite arrangement for generations. Discipline, consistency, and understanding the mechanics matter infinitely more than chasing the perfect rate or timing the perfect market. And if you're curious about how this applies to your specific situation, whether you're exploring real estate investing, need contracting work done on a property, or want to connect with lenders who understand these strategies, check out our links in the description below.